Okay, thanks, Kim. I think you also want to, highlight Rafael. He's gonna also
He's
be
also,
finished.
yep, yep. So I'll just kick off the introductions. Hi, everyone. I'm Ricky Dillon. I'm the account manager for Manny's team. Uh, I think it's what, 4 or 5 offices now. Maybe I lost track. Maybe it's like more than that. So, um, but along on the call, we're also going to we got Ryan and Raphael. So they're going to do like a state of the market just for Manny's team. Tomorrow we have our in market state of the market, but we set this up directly for Manny's team. So
Thank you,
I'll go
Ricky. And
ahead and I'll let those guys go ahead and introduce themselves, and we can kick it off.
yeah, and just one small thing is, thanks everybody for joining us, and I love to have our CoStar partners here give us a quick overview. If you have any questions, maybe during their slides, if it's relevant, or keep your questions to the end. But love seeing you, Ryan, as always. Rafael, good to see you. And go ahead and introduce yourself and take it from here. And we're gonna make sure to give you also a option to share a screen. Thank you, guys.
Great. So thank you for having us today. I am Ryan Patzap, Senior Director of Market Analytics, joined with my colleague Rafael. I focus on Los Angeles multifamily and office. So I will present on that, and then now it's my colleague follow up with industrial and retail. So let me move here so I can get my slides sharing. Screen 2. All right. Does everyone see my slides?
Yep.
Yeah, good to go. Thank you.
Great. So let's take a look at the multifamily sector. This graph is what we call supply, demand, and vacancy. If there's one graph that I think can capture what's going on in the market, it can't, but this is as close as it gets. Now, what we've seen over the last 2 years is a steady weakening of the multifamily market. At this point, vacancy is hovering right around 5%. Just a little above historical averages. I wouldn't say the market is terrible. It certainly isn't great. It's kind of so-so in between at this point. Now here we have the vacancy rate across the various submarkets in Los Angeles. As you can see here, quite a range. Towards the bottom, the more affordable, cheaper locations in LA, those that see less construction, tend to be the tighter market still, whereas those like downtown LA, which has seen the most supply added over the last decade and will likely continue for the next decade, has the highest vacancy rate. And that's pretty much the basic message here when you look at the various submarkets. In terms of our outlook for the market, we do expect a recovery to kick in the second half of this year. This is based on an economic scenario where we have slow near-term growth. We are not calling for a recession here, but we start to see better demand towards the second half of the year. And then supply is likely ramping down a little bit, not dramatically, but a bit of a moderation in 2024, later 2024 and 2025. Now, here's our daily asking rent series. Just want to show you the movements day to day. Rents are down now from a peak in the summer. We do see a bit of a stabilization now in December and January. So that'll be interesting there. But if you look at, over the last year, rents have basically gone nowhere. If you take from where we're at there to where we were at the beginning, basically is at the same point. But bigger picture, we have seen pretty strong rent growth over the last couple of years. And so here we're looking at the rent growth over the last 3 years. As you can see in 2021 and early 2022, saw pretty dramatic gains. And this was also experienced nationally. And what's also interesting is that this was record growth for LA, but it was still much less than the Sunbelt, Florida, and Texas markets that were seeing 20-25% year-over-year rent growth in the peak years. Now here we look at rent growth nationally. I just want to provide a comparison. LA's followed a pretty similar trend at this point. Rents are a little above where they were a year ago. So LA's a bit of a lagger, but not dramatically behind. It just says it shut. Close that. So here is rent growth across the various submarkets in LA. And so we take our top markets and our bottom markets in this graph here. So you can see LA is towards the top right, which makes it a bottom market, so kind of average. Clear deceleration in rent growth across the board nationally. Top markets were seeing 20-25% a year and a half ago. That has definitely shifted. What's interesting is some of the better performing markets are what I call the steady Eddie, boring Midwest markets, slower economy, economic growth, slower population, but they've had less supply. And I think that when you look on the contrast on the other side, where you have Austin and Orlando, that is really driven by the excess level of apartment construction they have seen and the deliveries that are hitting this year. Our outlook for the market, we do expect rent growth to accelerate by the end of this year, getting more towards trend-like growth. So this is really kind of a reversion to historical averages at this point, but pretty steady Eddie. When we look at deliveries, so these are the thousands of units that completed during respective quarter, we saw just over 11,000 units added, but we have over 1 million market rate apartments in greater Los Angeles. So when you calibrate it to the size of the market, it really isn't all that much. So this graph's a little complex here. The bars represent the percentage inventory growth, taking the number of units at the end of 2023 divided by the number of units at the end of 2022, whereas that number is just the absolute number. As you can see, we've seen some of the lowest supply growth of anywhere. The difficulties of building in LA. We have a shortage of housing. We've had it for a long time, and we are not developing enough. And most of this construction is in higher end units, which we do need less of. We need all the construction we can get, but it is concentrated in that higher end because those are the projects that make financial sense to build as opposed to workforce housing, just given the cost of everything here. Now, in terms of what's under construction here, we have 24,000 units underway. When you calibrate it to the size of the market, pretty similar in terms of what has finished over the last year. We have one of the smallest pipelines on a relative basis, whereas a lot of those Sunbelt markets really have elevated pipelines that, in 2024, early 2025, likely we'll see higher vacancy as a result of the market having to digest all this new product. Now here we look at office construction or multifamily construction and starts. And so starts represents the thousands of units that kicked off construction during that period. And then construction is just the thousands of units underway during that time. What we've seen nationally is a pretty clear downdraft in starts. This is the product of, one, the market weakening, but more importantly, I would say, is the rise in debt costs. With financing now much more expensive than what it was before, it's harder to make sense of projects. If your cost basis on land is high in this environment, it may be hard to get financing. And so that has really pulled back on construction. And we've seen that as well in LA, but I would say to a lesser extent, perhaps. Given the difficulties to build in Los Angeles, once you've got a project entitled, you're likely still going to build it, just given the difficulties of development, the time it takes to get a project ready to go. And so I think there is less sensitivity when you compare ourselves, especially to those Sunbelt markets. Now, in terms of what's under construction today, downtown LA and Koreatown are number 1 and number 2. They have been over the last decade. So that's pretty much a broken record there. San Gabriel Valley has seen quite a ramp up of construction in recent years, as well as East Hollywood. San Gabriel is really interesting because it's around these larger transit-oriented projects that I think is great, considering it's more a suburban area of LA, and we need to see densification, select densification throughout LA County. And East Hollywood is a story of, you've seen a lot of development in Hollywood over the last decade. You've got downtown Koreatown nearby. You've got the hot neighborhoods of Los Feliz, Silver Lake, hipster hoods. And so this is all trying to take advantage of its position surrounded by all these attractive areas. Now, looking at sales activity in LA, definitely significant impact from the rise of debt cost, as well as that thing called the transfer tax that started last year. When you look at it on a quarterly basis, as you can see, Q1 activity was still pretty strong. Sellers tried to get ahead of that transfer tax in the city of LA. And so we did see that elevated levels, but clearly have seen restrained activity since then. So the transfer tax and debt costs are having an impact on the market. Now here we look at transaction pricing here, and what we see here is pricing is down around 25-30%, but you see how those lines bounce around a lot. So you can have this issue of composition of sales where you could have higher quality buildings trade one quarter than lower quality buildings trade another quarter. But that doesn't mean that pricing necessarily moved. It was a composition of sales. But it is a signal that we're seeing definitely a downdraft in pricing, and pricing is down now around 25–30% based on this metric. Our other price series is a market price series, and this is where we try to estimate a price for every property in the CoStar universe. And this is showing around a 15% decline at this point, and our forecast is calling for around 25% losses by the end of this year when all is said and done. Does anyone have any questions on multifamily before I go into office? All right, let's keep going. Want to start this sector with a couple big picture slides to, I think, set up what we're seeing in office, because what's happening in LA, it's not unique. It's happening throughout the country. Most office markets are hurting and are significantly weaker than where they were coming into the pandemic. So this looks at office utilizations. This is Castle Systems data for the top 10 metros, and LA has been about in the middle of the pack when it comes to going back to the office. So I think this is pretty reflective of what we're seeing here. And it's pretty clear that we're flatlining in terms of utilization. We're at 50% of where we were. And so the office isn't dead, but we are going in less. Hybrid is sticking. And I do think that that does lead to a long-term net contraction in demand. And we are seeing that play out in terms of leasing activity. So this looks at leasing activity in 2023. And what we actually found is that we saw more leases signed in Los Angeles last year than what we saw pre-pandemic. However, leases are smaller. Sorry, this is national data here, but the trends reflect it. What's going on in LA? So leases on a national basis are down 20% on size, and volume is down to 15 to 20%. When you break it down by the various metros, LA is a relative underperformer. Our leases have contracted even more than the national average. So definitely seeing that, response as a result of the pandemic. People are rethinking their space needs. They are contracting upon renewals. They are putting their space on the sublease market. And so that is leading to more restrained leasing activity. The other thing I think to think about in terms of where we're going with the office sector over the next couple of years is that many tenants have not made their decisions on space needs post the onset of the pandemic. And what we are looking at here is nationally, the percentages of leases that have expired so far is just around 55%. So we still have around half of these leases to play out. And it's been clear that tenants have contracted. And so this informs our forecast where we do expect significant negative net absorption and vacancy continuing to rise in the market. Now here we look at office leasing volume, and so this represents the square footage of leases signed. And so activity is trending, probably around 75–80% of where we were pre-pandemic. So definitely some restrained activity there. And we see tenants continue to move out. And so this has led this vacancy just continuing to rise. We're above 15% at this point right now. It's the highest level seen in decades. Definitely a point of weakness. Here we have vacancy rates by the various submarkets in LA, and the big picture, markets are weak across the board. Exceptions are a couple towards the bottom. Those are more locally serving, more mom and pop tenants. Saw less occupancy growth in the steady Eddie years pre-pandemic. And so just more stable locations. Whereas in contrast, those locations that have the more innovative, cool, tech, media, creative tenants on the West Side, they've seen vacancy double. Higher end markets like Beverly Hills, same thing. And so more sophisticated tenants have responded in putting their space up, whether they vacate or whether they put space on the sublease market. So there's been a clear impact, and this is showing weakness. Now here we look at available sublease space in LA. And so just an explanation on sublease space if you're not aware. So say you're a tenant, office tenant, you signed 5 years for a lease. 2 years into that lease, you realize you don't need that space. So you try to get another tenant in there to pay you, and then you have to continue to pay the landlord. You're still on the hook for the lease. And so what we've seen here is tenants are trying to recoup costs on space and putting their space in the sublease market, but this puts downward pressure on rents because these tenants are just trying to recoup some costs. They're not trying to maximize profit in a building like a landlord. And so this creates a source of competition for landlords that is definitely restraining the ability of them to raise rents. And just a great anecdote here. This was a lease signed late last year by Sega Corporation as a sublease. They have a rent of $295 per square foot per month on a full service gross basis. That's around 40% less than what direct space is currently being marketed here. And you see this throughout LA County, example after example of sublease opportunities, 30 to 50% discount of what the direct space is asking for. Our outlook for the market looks pretty similar to what we've seen over the last couple of years. We do expect significant tenant move-outs still throughout this year and into 2025. Vacancy continuing to reach new heights quarter after quarter. So our view still remains pretty bearish on where we're going with the sector. Now, in terms of office rents, we've seen rents go sideways over the last couple of years, and that may be kind of interesting to some people, thinking the market is pretty weak, vacancies at record levels. Why aren't landlords budging? The reality is, in many situations, rents can only go so low before executing leases make financial sense. I'm hearing of even 10-year leases where, in terms of what you have to offer with free rent, tenant build-out costs, 6 years of the cost of the lease just to get the tenant in there. So you're only getting 4 years worth of income essentially. And so that, I think, is kind of creating some situation there. You've got the inflation that's happened over the last couple of years. So you have to have leases that make financial sense. And so this is where we've seen this flatlining here since the onset of the pandemic. Now, in terms of year-over-year growth rates, we are lagging, basically flat over the last year. You are seeing better rent growth in a handful of markets, but things are pretty slow across the board nationally. Our outlook does call for rents to soften a bit. I think that this will be interesting to see how this plays out. We know these are asking rents. We know concessions are elevated when deals are getting done, but there is a governor on just how low rents can go before we'll start to see deals trade. Other part I think will be interesting is, I think what we'll see is when distressed buildings sell, they'll sell at a discount to their previous sale prices. Their cost basis of the new landlord will be much lower. So they'll be able to offer lower rents. And so that maybe will be the way that we start to see rents decline as enough of these distressed buildings trade, get new owners, and then they try to lease up at lower rents, whereas the other older previous owner at that cost basis just couldn't do deals. Now, in terms of construction, we saw just around 2 million square feet of net new office space deliver. That's about 0.5%. So it does impact the market a bit, but really, when we're talking about weakness in the market, it is largely demand driven. Supply is really not the factor. So pretty modest levels of construction in most areas of the country here. This again looks at that percentage inventory growth. Looking at the square footage in the end of 2023 divided by the square footage at the end of 2022. And so pretty modest construction activity. Now, in terms of what's under construction today, we have 3.3 million square feet. That's not a lot. We have around 440 million square feet of office space in the metro. And when we look at construction and starts here, this is similar to what I showed with the multifamily slides. What you can see here is developers have clearly dialed back when it comes to starting construction. Most projects have been small and mid-size. What you see, that blip in the first quarter of 2023, almost all of that space is one speculative project in Century City, 1950 Avenue of the Stars. That really represents an exception. That is the one location in the office market that I hear is still that is relatively strong in demand. It's a expensive office market, but high image conscious tenants want to be there. I think it's also benefiting to some extent to some of the issues that downtown LA is facing in terms of crime and homelessness. And just people wanting to be away from that. And so that building is already mostly pre-leased and it will not complete until 2026. Sales activity, it's definitely have seen restrained activity since the beginning of the pandemic. When we look at things on a quarterly basis, a bit uneven. I think the first quarter was really the result of the transfer tax and trying to get those sales ahead. And the last quarter, I think, is kind of the opening of the dam. We're starting to now see more sales, get a sense of where pricing is going to land with the office sector. We've all just been kind of sitting and waiting here. And we have seen some notable sales towards the end of this year, seeing discounts anywhere from 30 to 60% of previous transaction prices. There are a handful of buildings that are still getting strong pricing. There was a sale in Santa Monica, the Pen Factory sold for $800 a foot, but 100% leased, great location in Santa Monica, 2017 renovation. So that's like 1% of the market there. So really have and have nots in terms of where pricing is. But we did see that rush of an increase in activity. And so I do think you're now starting to see sellers motivated to move on and stop kicking the can down the road. Now, here is a great sale to just point out where we're seeing pricing land. This is the Aon Center in the middle of downtown LA. Sold for just over 150 million or 140 a foot. Now below you can see the previous sales history. So it sold for well below its 2005 sale price, and significantly below its last transaction price in 2014 of 270 million. And so I would say this is a average building in I would say below average submarket for LA at this point. So this is what we're now seeing in the sector. I'm going to stop sharing now. Does anyone have any questions on office before Rafael presents?
Can I ask a question more about multifamily though?
Yes.
What you didn't mention specifically, like a mixed use, with the apartments on top and retail on the bottom. Are you tracking that separately, or because I heard that is becoming more popular?
Yeah, I mean, the city often has, LA and other cities often have requirements for ground floor retail to be built. And sometimes that's an issue. You're over incentivizing retail and then it doesn't get leased up. We're tracking that in terms of if there is a retail space listing, but the primary use of the building is what goes into our data set. So that smaller retail space in a vast majority multifamily building, that's not the retail data is not being mixed into the multifamily, and it's also not being included in our retail market data as well. That's really focused on the shopping centers.
Okay. Okay, thank you.
Great.
I'll go ahead and share my screen. All right. Thank you for having us today. Thank you, Ryan, for that update. I'll switch over to the LA retail market. But before I do that, I kind of want to take a step back quickly to sort of explain a little bit of the contrast of what we're seeing really across all commercial real estate nationally and locally. When you compare how commercial real estate is performing relative to the economy, right? We've had some pretty strong economic growth figures nationally. In the third and fourth quarter, we saw GDP accelerate. Whereas in the commercial real estate sector, we've seen conditions deteriorate, as Ryan just mentioned, in office and multifamily, and you'll see a little bit of that in retail and industrial in Los Angeles as well in a second. But when you think about the difference here, part of it is the rise in interest rate and how that's affected both capital markets and as well as businesses that are looking to expand, as that's affecting their borrowing costs. And at the same time, we were hearing so much about the potential for a recession in 2023, which we largely avoided. That's all factoring into business decisions as they're looking to become more efficient. And so when you contrast that with where we are now, where we know that we didn't have a recession in 2023, where the outlook for the economy is looking much more positive in 2024, I think you'll start to see that reflect in some of our forecasts for commercial real estate, where there is a little bit of slowing over the next couple quarters just because of the momentum of where demand has tracked in the last few quarters. But then after that, you start to see a little bit more positive growth. Now, for the alley market, it's a slightly different picture, I would say, because there are a few headwinds that we're seeing. What you're looking at here is employment. both non-farm employment and the amount of employed workers. Now, these are two different series that are tracked by the Bureau of Labor Statistics. We usually focus on the non-farm employment. These are the figures that come from businesses that tell us how many workers they're hiring each month. You can see here that when we compare to where we were pre-pandemic, we really only recovered non-farm jobs early in 2023. And then we've had pretty gradual growth since then. Whereas a lot of these markets that have high population growth, their non-farm employment recovered much earlier in 2021 and early 2022. So we've had a little bit slower growth in jobs, and that's a proxy for the economy. Now, employed workers, this is a survey of households. This is asking people if they're employed or not. So this is also going to include contract workers, your gig workers, those that are self-employed, and labor market conditions for those when you include them, they actually look a little bit softer. It looks like we haven't had much employment growth in about 2 years. So employment growth, this is something that affects all our property sectors, and this is one of the reasons that we're seeing a little bit less demand, specifically on the retail side. Now, we did have a pretty strong quarter in the fourth quarter in terms of net absorption. But when you put it all together with the entire year, we tracked about 275,000 square feet more that became vacant, net of that space that became positive. Vacancy rate ended the quarter at 5.2%, which has been pretty steady, over the last 3 years. And this is still much higher than where we were pre-pandemic. Now, there's a few things that are impacting the market. As I mentioned, population growth, that's going to be a drag for demand, especially if we continue to have population losses in the county. There's also a little bit less tourism. Tourism levels haven't quite returned. When we look at our occupancy data that we get through STR, tourism levels haven't quite recovered, and a lot of the tourism that we're lacking is from international visitors compared to pre-pandemic times. They tend to support retail demand in some areas more than others. And when you look at where demand has come from over the last few years, we see that demand has been strongest for neighborhood centers, and we saw that again in the fourth quarter when we look at just net absorption for the quarter. So that's what you're seeing in these green bars. We have seen pretty steady demand for malls, and we did see a recovery in the fourth quarter for strip centers and power centers. So it was overall a good sign in the fourth quarter. And as I mentioned, when you look at where the economy was, we started 2023 with huge calls for a recession, although it was a mild recession that was expected. We ended up with much stronger growth, and you can kind of see why businesses would become more optimistic as the year progressed. I'll show briefly where we're seeing demand in terms of the submarket clusters. Now, we track over 50 submarkets, retail submarkets in CoStar for LA. They're difficult to show in one chart, so I cluster them by region, you could say, within LA. There's a few trends to pick up here, and keep in mind this is 4-quarter net absorption. I wanted to make this a little bit smoother so that you don't see numbers bounce around quite a bit. Really, the trends that I'm monitoring here is that some of the more suburban parts of the metro have been the best performers for the last few years. Places like North County, this includes Santa Clarita and Antelope Valley. We did start to see that shift at the end of 2023, where we saw some of these other submarket clusters that have more of an urban lifestyle see a little bit stronger demand in the fourth quarter. Places like West LA and the South Bay. Now, in terms of supply growth, similar to what we were seeing in office and multifamily, there just isn't a lot of supply risk in LA because of the amount of space that's under construction relative to its size. We're tracking about 1.7 million square feet of retail space under construction. You can see here from the orange bars that ground breaks were actually pretty low in 2023. In terms of the types of projects that we're seeing, they tend to be smaller in scale. One of the few exceptions is West Harbor, the redevelopment of Portocal Village in San Pedro. It's a 375,000 square feet project that's underway and expected to complete in May of 2025. We also have outlets in Carson, but other than that, most projects are relatively small in size. Now, with limited supply and, as I mentioned, the outlook for the economy and consumer spending improving, we do expect to see vacancies edge lower over the next 5 years, ending at about 5% in the end of 2028. Sort of, when you think about this, also helping demand for retail is going to be what we see in that recovery for tourism, because that's been one of the areas that has been lacking for the LA Metro and an area of potential growth. So I think if we do see bigger, a faster increase in tourism, this I could really see the forecast, or I could really see the retail sector outperforming the forecast in the next couple of years. Now, in rents, we're seeing a pretty similar trend in terms of rent growth, where rent growth has been decelerating. It ended the year at 1.3%. That kind of bump in demand that we saw in the fourth quarter isn't quite translating to rents quite yet. And in our forecast, we do expect slightly less rent growth in the first half of next year, but then we expect growth to accelerate in the second half of the year. But one thing to keep in mind is that at the same time, many retailers are adjusting to the higher cost of doing business in LA, both because of borrowing costs and because of labor costs. One thing I always think of whenever I look at rent projections for the local market is what tenants are facing in terms of these costs. Just thinking about something like minimum wage, which was raised to almost $17 last July in the county. It'll go up to about 17 and a quarter this July. And if we're looking specifically at fast food workers, that's going to go up to about $20 per hour. So you can see that a lot of tenants, certain sectors are going to face some challenges in terms of labor costs. So it's something to keep in mind as we're going forward. In our forecast, rents are expected to grow by an annual rate of about 1.9% over the next 5 years. Now, keeping that in mind, in terms of sales activity, we did see a sharp deceleration in sales, similar to office and multifamily, as Ryan mentioned. I will say that in 2022 and early 2023, one of the bigger, a lot of the sales volume came from large shopping malls. We're seeing less of that now. We're also just seeing, less institutional capital, and we're seeing just smaller deals happen overall. I'll give you an example of sort of a more kind of average type of trade that we're seeing in the last couple months. This is a Barnstall Square in Los Feliz. It's a 30,000 square foot anchor pad that's sold for $11.2 million or $389 per square foot. This is fully leased to John's Supermarket. Now, in terms of pricing, I know we're seeing a lot quite here. Ryan mentioned how the thinner line is our average transaction price that tends to vary quarter to quarter depending on the types of assets we're seeing. Our market price shows that price appreciation did slow down significantly in 2023, with the market price up less than 1% year over year. We think that valuations have suffered a little bit more than that, and in our forecast, we're calling for prices to decline by more than 10% over the next 4 quarters. I would say that a lot of the decline that is in our forecast is actually already been observed. It's already being talked about. It just hasn't translated into many closed deals yet. And then in our forecast, as space conditions begin to improve after this current year, then we expect to see recovery in prices. I'll switch over now to the industrial market, which is driven by some of the same factors, right? It's about consumer spending. It's just more of how we're storing our goods and how much we're importing really from other countries and how we're storing all those goods. Port activity did slow down significantly throughout 2023. We started to see a little bit of recovery at the end of the year, with fourth quarter imports growing by about 20% compared to the fourth quarter of 2022. But when you compare that to where imports were 2 years ago, it was still shy by about 10%. So we did start to see a bounce back at the end of the year, but overall we've had less import activity. When you look at historically where imports have gone, you can see that we've had strong growth for several decades, really. So for a market to adjust to this slowdown in imports, it's been quite a drastic change. In our fundamentals, we've seen the vacancy rate rise from a record low of 1.7% at the first quarter of 2022 to 4.3% at the end of the fourth quarter. We tracked really the worst year for the sector with in 2023 with 15 million square feet of negative net absorption. But looking a little bit deeper at where the loss in demand came from, what we're really seeing is more of a normalization in terms of the types of buildings that have been in demand and the types of buildings that have not been in demand. Now, historically, as you can see here, there's demand losses for older buildings. They become aged. They're not as useful for modern logistics firms. They get redeveloped in many cases or renovated. And so when you look at buildings that are typically more than 20 years of age, it's normal to see negative net absorption, whereas you see more demand for buildings that are under 20 years of age. In 2021, we saw that reverse. And what this really was just a lot of firms who were looking for any space that they could find to help grow their business because of how much demand there was from consumers for durable and non-durable goods. In 2020, at the end of 2022 and throughout 2023, a lot of firms have been shifting more towards efficiency and really just leaving behind some of these older buildings and really focusing more on the buildings that make their operations most efficient. That said, though, we are seeing a rise in the vacancy rate in buildings that are 5 years or younger. We'll see vacancies are at about 14%, so that is something to monitor. It is a much smaller proportion of the total inventory, though, and because new buildings are often, leasing up, it's not, uncommon to see vacancies this high. Just something more to monitor as we move through 2024. Now, some of the demand loss, or the biggest demand loss we see that in terms of submarkets in 2023 happen in these submarkets that are more mature and have a lot more of this older stock, places like Vernon, Commerce, and so those closer with bigger ties to port activity. And then on the supply side, for LA, we do have quite a bit of construction, for Los Angeles than we've seen in recent years, but it is still a very small share of its inventory, and you have other markets that are growing much more. So in terms of supply risk, it is pretty limited. We're tracking nearly 6 million square feet of industrial space under construction. Most of the space is in the San Gabriel Valley, including the city of industry. This is a pretty huge contrast to what we're seeing nationally, where construction starts have really plummeted. So in LA, because it takes longer to plan a project and go through entitlements, the timeline is just much longer. Now, when things start to slow down nationally, if you have something that's underway, you're going to see it through. You're going to continue, to make that happen, just because of how scarce new product has traditionally been in LA. I'll give you one example of a project that's underway. This was 3 buildings in Grand Crossing South, buildings 4 through 6. Although building 4 just completed at the end of the year, but in total, this is 1.5 million square feet across the 3 buildings. It's owned by Majestic Realty. In this complex, there was also a 1 million square foot building that completed construction last year as well. Our forecast, however, does call for the vacancy rate to rise to 5.1% by next quarter, after which we'll expect to see demand start to outweigh supply. A lot of the space that we're tracking to become vacant, or a lot of the increase in the vacancy rate, is already observed. It's space that we already know has become available this quarter. So the model portion of the forecast does expect that we are at or near the peak of vacancies right now, and we expect conditions to begin to improve. We've seen a pretty similar story in rents, where really in the last 3 quarters, we saw rents pretty much flatten. Sharp deceleration in rent growth from where we were, a year and a half ago, when rents peaked at about 14% growth. For tenants that are looking at any renewal after 3 or 5 years of being in their space, they're at the point they're seeing stick shock in terms of because of how much rents have grown. So it's logical to think that there's going to be a little bit of pushback during this year. But after that, as market conditions start to improve, our model suggests that that rent growth will return to a historic growth of about 5%. In capital markets, similar to the other property types, we saw a pretty sharp acceleration. As I mentioned with retail, it's really been more of the larger deals that have slowed down the most. There's still lots of sales in the under $10 to $20 million range. A lot of the bigger sales that have closed, you can kind of see the opportunities pretty clearly in terms of why these properties are being purchased. I'll give you one example. This is an older warehouse in Commerce that has great access to the 5 on-ramp. It was built in 1951, occupied by the Gurr Group, who was actually the seller. They're leasing back the property for just 9 months, acquired by Prologis for $50 million or $209 per square foot. So there's plenty of options for this building. I would guess that it gets redeveloped in the next couple of years. In terms of pricing, we have seen a slowdown. We did see a slowdown in the second half, but keep in mind there were much fewer sales here, so a little bit less to observe in terms of the properties that were being sold. Our market price did track 4% lower year over year in the fourth quarter. We expect to see another similar year in 2024 with prices falling by about 4%, and then afterwards, market conditions began to recover. So that's what we have for our prepared material. I believe Ryan's still on the line, so if you have any questions, now's a good time.
Anyone have any questions? I was curious when you were showing those slides about the vacancy rate for industrial. Do you track at all the like how many industrial units might have been repurposed, and if that helps after the pandemic?
What we do is we take them out of the inventory. So let me pull that chart up again. So let's see here. Whenever you see net deliveries negative, those are buildings that are coming out of commission. So they're getting demolished, or if they're redeveloped into another property type, then they become negative deliveries. As you can see, we're seeing less of that, right? Really since the start of the pandemic, we're seeing less of that. And when you think about it, a lot of these buildings were, the target was creative office conversions, but that's just, I imagine that's just not a popular play these days. And so without, much demand for the conversions, and I would imagine that there's going to be less demolitions of older industrial buildings. That doesn't mean that they're not becoming vacant, and I think that's what we're seeing, that some of these buildings that might have been targeted for another use, they're now just sitting vacant.
Okay. Okay, thank you. That was super thorough. Anyone else have anything?
I have a quick question, Kim, and what is the negative absorption rate? I'm curious.
What does that mean?
Oh, yeah. So negative absorption is when more space becomes vacant than becomes occupied. And so typically, you're thinking of absorption or positive absorption. That's how much demand there is in the market. But because it's not always positive, then that's when it becomes negative. So when more space becomes vacant.
Thank you so much. Appreciate it.
Okay.
Kim, I was wondering, are you recording this, and would you be kind of send this to us?
Yes, I definitely will send this out when we're done. And Ricky, is it okay if I put a few of the slides on our social media?
I don't see why it wouldn't be a problem.
Okay.
Ryan, Raphael, would that be a problem?
I think that's fine.
Yeah, this should be fine. And Raphael, do you have the sharing right now?
I put it down.
You
You want to
okay?
share?
I just wanted to share one thing real quick before we go.
Yeah, you should be able to, Ricky.
Okay. Why isn't it? Okay, let me see. Let me know if you can see my screen. Can you see my screen on the loan
Yep.
data and property records? Just a quick thing. I wanted to point out on CoStar. We did launch CMBS loans. So along with the CMBS loans, there's also a tab right here for financial statements. So I just wanted to make sure that you're all aware of that's some new content that we added recently, and we also added funds. So anyone that's got questions on that for CoStar, I'm happy to go through that with you. There's a lot of loans coming up within the next year that could be a significant trigger event for some of these owners. So I just wanted to make sure that you're aware of that.
Okay. What was the tab, Ricky?
Oh, it's there's a loan tab inside of
Loan tab.
CoStar.
Okay.
Yeah, so the CMBS loan data, and then besides the loan data, there's also the financial statements that tell
Okay.
you exactly how the performance of a company or the building's doing. So it has everything you can think of on the financial statement, and so you can tell the health of the building. But the
Great.
loans is great because it gives you all the commentary, and if it's on a watch list, so you know that there's some issues with that property and that loan. So that's something that I wanted to reinforce, that you all have access to that who have CoStar, and any questions I do. I do trainings with people all the time. I can come by the office, do one-on-ones, or we can do it via Zoom. Either way, I'm really flexible.
Oh,
I
Ricky,
just
do you want to
need,
put your number in the chat?
yeah, I'll do that. Yeah. Let me see if I can do that. Let me see. I'm doing something wrong. Wait, let me try that one more time.
Do you want me to put it in if it's not showing up?
It should
Oh, there
be.
you go.
Oops. Oh no. Okay, wait a minute.
There you
I'll
got
try
it.
that. Let me
Oh,
try it again,
yeah,
everyone. Sorry.
that's okay.
My glasses aren't working today, I guess. I don't know. All right. So just feel free to give me a call or send me a text, and I'm happy to schedule time with you. All right. And if you have questions, you don't have CoStar, I'm happy to show you what it's all about and how you can make money using that platform. So
Perfect.
Ricky, can I ask you a quick question, please?
of course.
Would it be correct to say that your number is 213-500-0613? Is that
Yes, that's correct.
okay?
Yep.
Okay. And the 110,000 loans that is in CoStar at the moment, are these for LA County? Is it
So
like just
there's CMBS loans. So they're like commercial mortgage-backed securities. So these loans, they're heavily tracked because there's a reporting requirement on them. So that's why we have all this great data on them. We get the loans from a third party that we pay for, and then we give that information to you. And then if not every property is going to have a CMBS loan, but then we actually can look it up the loan data on the public record tab. So there's a lot of different ways that we can find information on like loan origination and like how much down payment they've done or the loan to value. So there's other ways that we can look at that if it's not a CMBS loan.
thank you.
Okay. Well, thank you so much for the information, and you were so thorough in every sector, so we appreciate that. Because we have a mixed crowd here.
So Kim, everyone on the crowd, everyone in the audience right now, I mean, is everyone's commercial, but is there any residential folks on the line?
You can speak up if you are. I mean, I know we have some people that
Well,
dabble in both.
okay, because I know in the future we'll be talking about this too. So we bought homes.com basically for the URL, and what's significant about that is we're relaunching that website on basically it's gonna start. You're gonna start seeing a lot more information about it on the Super Bowl. We're gonna do 4 ads, and then anyone that wants to talk to us after the Super Bowl, or talk to me directly, I'm happy to tell them more about it. And it's going to be something that's totally changing the way residential real estate and how brokers transact, because we're not going to do the same model as the others out there, which is charging you 40% and hijacking your listings. The listing is going to be your listing, it's your lead, and it's something that we can talk more about like anytime after the 12th. So anyone on the call that wants to talk to me about this, I'm more than happy to walk through that with you. But I just wanted to kind of make an announcement that this is one of our companies, and we're following a similar approach to what we did with apartments.com, where we bought the name, we completely redid the website based upon thousands and thousands of we did peer groups across the country with residential agents, with the homeowners, and we got their feedback, and they said this is what we wanted to see in a site, so this is what we're going to bring you. And so we'll talk more about that anytime after the 12th.
Okay, yeah, we
Ricky,
definitely have to hear more.
Ricky, I just want to let you know that I'm already receiving emails from homes.com. I didn't know
Good.
it's CoStars. That's great.
Yeah.
So maybe in a few weeks I can call you guys
Call
and
me. Yep. Call me
learn about it.
directly. Yep. Call me and we'll set up a time and I'll walk you through everything.
Beautiful. Thank you.
You're welcome.
So you said the site is already on, or it's gonna be
No,
launched?
we're basically relaunching it. It's already out there, but I would suggest that you contact me anytime after the 12th, and then we can talk about like what I can do for you. So I would just
Sounds good.
hold on for another week, and then we can talk more anytime after the 12th.
Sounds good. Thank you so much, Rick. I will talk to you.
Sounds great.
Okay.
And thank you very much, Kim and Manny and everyone for allowing us to be on your call. And we look forward to always working with you and supporting you any way we can. And thank you very much for your time today.
Thank you. Thank you both. Have a
Thank you,
great
guys.
day, everyone.
Thank you.
Bye-bye.
Bye-bye.